All right, you might have heard of a term called velocity banking. It's this idea of using another loan to pay off another loan, and it's honestly it's just horrible. And there's tons of videos out there. I'm going to show one in particular. We're going to go through it, and I'm going to show you why this is just not a good idea. Do not do this strategy. All right, let's see. All right, so this is a video off of the Fantastic channel. Okay, 77,000 views, 2.6 thousand likes. And she's going to go through what this concept is.
If you have a family member that has recently obtained a mortgage, they have to watch this. I am taking a 30-year mortgage, $250,000 at 4.5%. The mortgage payment on this 30-year mortgage would be $1,267. That is the payment towards the mortgage only. That does not include the taxes and insurance, none of the escrow account. Okay. The comparison here is $10,000. To get to $10,000, what do? We make payment.
All right. So the concept, at least the initial concept of the video, is how quickly can you pay down $10,000 of the principal of your mortgage? Okay.
Right? If we want to keep paying off our home, we keep making these $1,267 payments. So according to the calculator, and please go pull you up a Carl's Mortgage calculator, insert your numbers, $250,000 at 4.5% for 30 years. Okay, you got it? Now, you're going to see that when you run the numbers, that $10,000 of principal will be paid on this $250,000 mortgage in May of 2025. Actually, it's not even $240,000. I think it's like $241,000. But
okay, first of all, why? Again, she did the concept of the video is $10,000 being paid down, and if you caught that, what she just said is she's going to 241,000 for this example. So she says 26 months. Just looking at the actual answer. So she says 26 months, and this is an amortization of the data that she collected. So yeah, that's why, 241,000 is the ending balance. She should have said 28 months, I suppose. But for some reason, she decided to go with 26. No idea why.
I'm still playing the game, okay? After 26 months now of making these payments to the mortgage, you reach that $10,000 threshold you were looking for, so you could say you paid $10,000 on that home, and it's slowly becoming yours, right? So the totals that you have paid for 26 months is $32,934.46. The total interest that you paid was $23,955.10. So you paid $23,955 in interest just to be able to say you have paid $10,000 on your home. Now let's look at a line of credit. If you were to take $10,000 off of a line of credit and just throw it into the principal of your mortgage, what would happen? And let's say that $10,000 is at 20%, not 4.5%. 20%.
All right. So first step of this velocity banking concept is to go get another loan, a line of credit. And in her example here, it's okay if it's even 20%. Okay. And to use that line of credit to pay down the original mortgage in chunks. And we're going to go over this in the spreadsheet. I'm going to show how this actually works. But let's continue watching what she's getting at.
%. That would mean that 10,000 times 20% is $2,000, right? For the whole year, right? Are you seeing where I'm going? So in a whole year, if you let $10,000 sit on the line of credit, then you're going to pay $2,000 in interest to use that money. But if you had an income of $5,000, you had $4,000 in expenses that came out every month, then you would have $1,000 in cash flow, right? So if you use the velocity system. All
right, so this part up here is pretty important. She talks about what your income is minus your expenses, and then I don't know why she calls it cash flow, but the net income left for an individual or family or whoever is $1,000. Okay. And she's suggesting to take all 5,000. This is a key point here. You have to remember, I'm going to show the spreadsheet why this math is flawed, at least when comparing apples to apples. She's taking all $5,000 to pay down the line of credit. Okay.
You put your income in, you pull your expenses out, your interest would then be figured. If you did the velocity system.
So pay attention to what she's saying here. This idea of income in, expenses out. Okay. Balance on the spread on the line of credit. Use your income in to pay down the balance. Take out the expenses to increase the balance back up. Okay.
To where you did your income in and your expenses and your interest out, it would figure the interest at about $125 just for the first month. That would be your high that you would pay. So even if your high was the $200 a month from where you paid the 20% on the full $10,000, you still haven't reached the $23,955 in interest over here for 26 months. So if we pay this off in 10 months, just doing basic velocity banking, not even really getting serious, not if you had a higher cash flow, not if you had extra money, we're talking about just your income in, your expenses out. There's no additional payment on this line of credit because you are transferring your income in. This pays off in 10 months. This 10 months saved you 26 months in interest payments. You are max $2,000 interest over here. If you let this run an entire year, the way we do velocity banking, it would be paid off in less than 10.5 months. Or you can pay 26 months and pay $23,955. It's just math. Anybody can do it. It's basic math. It's just math that we weren't taught. We weren't taught it.
Okay, I love that part, by the way, because remember what she just said. It's just math. It's basic math, right? Let's take a look. The actual math is, here's the inputs, okay? $5,000 income. This is how the velocity banking methodology is being portrayed as, okay? Income of 5,000, expenses 4,000, net income again. She calls it cash flow. No idea why. Line of credit of 10,000 and a lock of 20%, the lock rate. Okay. So she's saying take $10,000, put it right towards the principal of your mortgage, the original loan. Then use the full balance of your income. Listen to that carefully. The entire income to pay down the line of credit. Okay. Then take out all the expenses, which is $4,000. And you have an ending balance of, in this example, $9,000. Now, isn't this interesting? The difference between the beginning balance and the ending balance is the net income, everybody. You're just paying down a loan with your full income. There's no excess here. There's no leftovers. So it's fictitiously making it look like you're paying your mortgage down faster, but really you're just putting more money into paying down the loans. In this case, a second loan. Nevertheless, let's look at our math, see how it flows through month to month. Okay, so you take the ending balance and the interest you would have paid on the ending balance. In my example, by the way, I took the interest at the end. I could have probably taken it more like in the middle because expenses kind of come out in chunks unless you're using a credit card, I guess. But nevertheless, you then roll it the next month. You do it over and over again until the very end. She said 10 months. At the end of 10 months, you were at $819 still in balance. So you're a little bit more than 10 months. So I think she did say about 10 and a half. During the life of this 10-month period, or 10 month and a week or so, 10 months and 3 or 4 days, you're paying $833 in interest. Okay, remember that. Okay, and I'll get back to that later. Now let's look at what's really happening with her analysis. So first of all, on the mortgage side, first of all, here's her mortgage. Here's the cash flow that she called. She is right that the original mortgage, well, again, like I said, it's 28 months. I don't know why she decided to change her own video metric from 10,000 to 9,000, but this is all the interest you would have paid if you just did the mortgage. Now, don't forget, this doesn't include you inputting $1,000 every month. Okay. All right, let's take a look at now the velocity banking method, okay, that she described in the video. First of all, you'll notice that the balance starts off $10,000 less because you make the deposit day one, right, of $10,000. By the 10th month, you will have paid in interest on the original mortgage, $8,937.48. Okay. The line of credit interest over that 10-month period is $833. Okay. So total interest, combining both the original mortgage and the line of credit, is $97.70. Now remember, you're putting all your income towards this. Okay. Even that extra $1,000, which we could talk about all the reasons why not to do that or whether that's a good idea or not. But just to keep it apples to apples, instead of doing a line of credit, instead of doing velocity banking, just stick the $1,000 into your principal payment every single month of your mortgage. It's that simple. Let's see what happens when you do that. When you do that, you actually get down to about the $10,000, which was the goal of the video, $10,000 pay down, at about month 7.5, let's call it. Okay? Not 10 and a quarter, like her velocity metric is, but 7.5. Now, to keep it even more apples to apples, let's just say you took it all the way down to the 10 months on both scenarios. You'll have a remaining balance on the velocity banking method of $236,270. In the $1,000 pay down every quarter or every month, you have $236. So you have a slightly higher balance of about $211 or so. However, how much interest did you pay? Look at this, $91.48. Here, $97.70. You're paying over $600 more in interest. And in this example, that's what, about 6.5% more in interest payments? It's kind of a lot. That's over just one chunk. Now, obviously, the natural next question would be, well, what if you did this throughout the life of the whole loan? Okay. Let's take a look. What I did here was the $10,000 chunk deposits every 10 months and did an amortization schedule based on that. You'll find that you'll pay off the entire mortgage 141 months in. Okay. You'll pay on the original mortgage $70,091.12 in interest. All right. However, that doesn't include the line of credit interest. I did a quick check. Obviously, the answer is, or the question is, how many chunks are there? Well, there's about 15 chunks, a little bit less actually, because the very last chunk, you don't need the full 10,000. You only need about 2,700. So there's 14.274 chunks at $833 each chunk. This is assuming the interest rate doesn't change, which we'll get into. Lines of credit, the rates do change. At 20%, I hope it goes down. But nevertheless, you have velocity extra interest of $11,900, almost $11,900. When you add in both the original mortgage interest and now the velocity interest, you're at $82,000 that you would have paid during 141 months. How does that compare to if you just forget the line of credit, forget the velocity banking, and just stick it right into the mortgage every month? Well, let's see. The mortgage, putting in $1,000 every single month, is done in 143 months. Okay, so slightly slower, admittedly. This is about 141 in a week. 7 weeks later, or about 7 weeks later, you're going to be finishing the original mortgage. But look at your interest, 73,000. That's it. No other surprises. Compared to 82,000 for velocity, $8,700 more, 12% increase in your interest if you go velocity. So yeah, you save 7 weeks, 12% more. This is her examples, by the way. So what are we gathering from this? Let's summarize this for a bit. First of all, velocity banking, the idea of using another loan to pay off a first loan, doesn't really work, okay? Unless for some reason a second loan is lower interest rate, then perhaps it might. I'd have to run the numbers. There's some sort of weird, I described it as order of operations, but the order of operations just doesn't make sense with the velocity math. And what I mean by that is all the examples I've seen, they are suddenly taking 100%, I got to make that bold, 100% of income towards the paydown of the lock. While when compared to the traditional mortgage, they are not. They're just saying, oh, you have a net, she's calling it cash flow, you have a net income of $1,000 in this example. So you have to compare apples to apples. You have to apply all the income to the mortgage to compare it properly. And that's the big thing here. I say this is like where it looks like magic, but it's not. So let's also talk about, I want to conclude here with lock realities. Okay, first of all, timing. Most likely, a mortgage and a line of credit are not going to be available to you on day one of closing. Okay, you buy a property. So there is a way to do it. I've done it before with a rental property where I combine both of them on the day of closing, but there's something to be aware of. Getting approved. Not only do you have another loan or lien on your house or on yourself if you're taking a personal line, but if it is for a house, you are capped at usually 80% of loan to value. So you got to have some equity in there, some cash in the house. Okay. The rates float, something to be aware of. Could be good, could be bad, but the rates do float. Sometimes there's other fees. There's dormant fees. There's setup fees, just to be aware of. These things do expire and they need to be renewed, usually less than the mortgage length. Okay, 5 years, 7 years, things like that. The hassle of getting one, for what I've now shown, is a net negative benefit. You're literally paying more in interest and you're barely making it faster. Okay, mainly because of this velocity math is no good. And this last one I want to spend a little extra time on. Okay, if you're having problems paying off your debt, if you're having debt issues, do you really think taking out another loan is a good idea? You might be excited about this strategy. You might have watched that video and said, hey, okay, so I'm going to do this. I'm going to get out of debt in 6 years, right? And you do it the first month. You're motivated. You want to get out. Maybe the second month. Third month, you had a rough day at work. It's Friday. You're going out. You deserve this. Go get those new shoes. You have the line. You have extra cash sitting there. Go do it. Just enjoy yourself. You deserve it. That's what's going to happen, okay? You're going to slowly, all of a sudden, not have $4,000 a month in expenses. That 1 month, $4,300. All right, you're back at it in month 4, right? It's okay. I'm going to redo this. I can recommit. Month 5, month 6, yeah, I really deserve to go out. I think you guys get it. So the risk of adding more debt in a situation where you're trying to get rid of debt is high. And by the way, the math just doesn't work. So I sincerely hope that this video makes it your way, because if you're like the other viewers, and a lot of the comments in the video are great. They think this is awesome. They're doing it without actually running the numbers. And she says, again, hysterically now, simple math. It's simple math, right? It is simple math. It's just not done correctly. Hope you have a great day. Thanks.